Hello everybody, today we will make a revision for the ratio analysis chapter. Let's start with the profitability ratio. Profitability refers to the ability of the company to turn trading operations into profits. There are two main ratios in the profitability ratios. The first one is gross profit margin, which is equal to gross profit divided by sales multiplied by 100. The second one is net profit margin. It's equal to net profit from the name, net profit divided by sales multiplied by 100. Again, from the name of each one, gross profit margin equal to gross profit divided by sales multiplied by 100. Net profit margin equal to net profit divided by sales multiplied by 100. In each exercise, he will give you some notes for each ratio. For example, here in this box, he gave you profitability evaluation notes. Budget. What the meaning of budget? This means the expected gross profit in the next year, how much it will be. So in the budget, gross profit will be equal 100%, and the net profit will be equal to 12%. Last year, which is already happened, the gross profit was equal to 45%, and the net profit was equal to 11%. The industry average, which means that the average of the whole industry for the gross profit was equal to 48%, and for the net profit was equal to 16%. Now, let's move to our exercise in class exercise 1.1. What is required in this class exercise? Required: calculate the profitability ratio observed and comment on your results. So he gives you the financial statement on page 121. On page 121, he gives you the income statement and the statement of financial position, and requires you to calculate the gross profit margin and the net profit margin and comments. So in gross profit margin, how to calculate the gross profit margin? The gross profit margin is equal to gross profit divided by sales multiplied by 100. And how to calculate the net profit margin? It's equal to net profits divided by sales multiplied by 100. Now let's compare what we have on this year with the expected and the previous year and with the industry. As we said before, the gross profit was equal to 50% on the expected year, which means that the gross profit for this year is less than the expected gross profit by 2%. So it's 2% less than the budget. And in the previous year, the gross profit was equal to 45%. And this year we achieved 48%, which means that we are higher than the last year with 3%. And we are equal to the industry, because the industry gross profit was equal to 48%, and now we are equal to 48%. Regarding to the net profit, the net profit we achieved this year was equal to 15%, which means that we are higher than the budget with 3%, and we are higher than the performance of the last year with 4%, and we are below the industry with 1%. Now let's calculate the return on capital employed. What is the meaning of return on capital employed? The return on capital employed evaluates net profit from the income statement to the amount invested into the business by all investors. How to calculate return on capital employed? Return on capital employed equal to the net profit divided by, open bracket, closing capital plus long-term debt multiplied by 100. As we said on the profitability ratio, he will give you a box of the notes for the budget. What the meaning again to the budget, which means that the expected of the performance for the next year of the company. The last year, that's what the company already achieved in the last year. industry average, the industry as a whole. So again, let's review what we have said. We talk about profitability ratio, and we said in the profitability ratio we have two main ratios. The first ratio is the gross profit margin. How to calculate the gross profit margin? It's equal to gross profit divided by sales multiplied by 100. The second ratio is net profit margin. It's equal to net profit divided by sales multiplied by 100. And the last one we take now, it's the return on capital employed. How to calculate the return on capital employed? It's equal to net profit divided by, open the bracket, closing capital plus long-term debt multiplied by 100. Now let's move to in-class exercise 2. Similar to the profitability, he gave you from the same statement of financial position and the income statement of the previous exercise. He required you to calculate the return on capital employed ratio and to comment on your results. As we said before, the return on capital employed equal to net profit divided by closing capital plus long-term debt multiplied by 100. We achieved 27%, which is higher than the budget with 3%, and lower than the last year with 2%, and lower than the industry with 2%. The return on capital employed for the business owners should also reflect the risk taken by the investor by investing in the business. How to calculate working capital ratio? The working capital analysis and control refers to the ability of the business in maintaining the relationship between current assets and the current liabilities. So from the definitions, it's the relationship between current assets and the current liabilities. We have two main ratios, the current ratio and the quick ratio. The current ratio is equal to current assets to current liabilities, and the quick ratio is equal to current assets less inventory divided by current liability. So the difference between the current ratio and the quick ratio is that in the quick ratio we deduct from the current assets the inventory. So a quick revision for the ratios we said. The first two ratios is the profitability ratios, which are the gross profit margin ratio equal to gross profit divided by sales multiplied by 100. The second ratio is net profit margin, which is equal to net profit divided by sales multiplied by 100. Then we have return on capital employed, which is equal to net profit divided by closing capital plus long-term debt multiplied by 100. Then the new two ratios are current ratio and the quick ratio. The current ratio is equal to current assets divided by current liabilities. The quick ratio is equal to the current assets less inventory divided by current liability. As we said before, we will have a notes for each ratio, working capital evaluation notes, and give you the budget to compare with the budget and the last year and the industry average. So let's move to in-class exercise 3. In-class exercise 3, given the same, he gives you the current assets and the current liability and require to calculate the current ratio and the quick ratio and comment on your results. Don't forget to comment on your results in every ratio. So here it should always be remembered that the financial reporting summary totals are constructed from groups of underlying data, with each data item requiring effective management and to control to achieve the required results. Let's move now to in-class exercise 3 using this data. So first of all, he calculates the quick ratio, and then he calculates the current ratio, and then he moves to calculate the quick ratio. How to calculate the current ratio? It's equal to current assets divided by current liability, and the quick ratio is equal to current assets less inventory divided by current liability. And the current ratio here is lower than the budget and higher than the last year and lower than the industry average. Regarding to the quick ratio, it's lower than the budget, higher than the last year, and equal to the industry average. It should also be remembered that the budget ratio planning creates expectations that managers will work towards on a daily basis. This is an aspect of individual and group motivation relevant to the study of business and business accounting. So now, how to calculate working capital ratios or liquidity ratios. Liquidity analysis refers to the ability of the business to turn trading operations into cash. The results of this will also appear in the working capital section of the statement of financial position. We have four main ratios in the working capital ratios. We have three main ratios. The first one is average debtor repayment period, which is equal to a closing receivables divided by credit sales multiplied by 365 days. Then we have average creditor repayment period. From the name, creditors who are the payables, so it will be equal to closing payable divided by credit purchases multiplied by 365 days. And the last one, average stock holding period, which is equal to average inventory divided by cost of goods sold multiplied by 365. How to calculate the average inventory? It's equal to the opening inventory plus closing inventory divided by 2. So again, we have three main ratios in the liquidity ratios. The first one is average debtor repayment period. The average debtor repayment period. The debtors are the account receivables, the receivables, which is equal to closing receivables divided by credit sales multiplied by 365. The average creditor repayment period, which is equal to closing payable divided by credit purchases multiplied by 365. The last one, average stock holding period, which is also known as stock days, which is equal to average inventory divided by cost of goods sold multiplied by 365. And it will be, the average inventory will be equal to opening inventory plus closing inventory divided by 2. Liquidity ratios are constructed using the relationship between accumulated totals from the income statement and the closing balances values from the statement of financial position. The trading account of Jeffers is shown below. So he gives you the trading account of this company on this box. He gives you the sales, he gives you the opening inventory, the purchases, and the closing inventory. Then he calculates the cost of goods sold, and now he has a gross profit. Now let's calculate the working capital ratios. And he gives you, as usual, the notes in order to be able to compare the performance of this year with the previous year and with the future year or the coming year and with the industry as a whole. So moving on page 124 in your book, on 124. Look to in-class exercise 4. So in class exercise 4, he calculates the three main ratios for the liquidity ratios, which are average debtor repayment, and then it's equal to 30 days. How he calculates the 30 days? It's equal to closing receivables divided by sales multiplied by 365. So it's equal to 30 days, which is in line with the budget or the expected, and lower than the last year and lower than the industry. On the average creditors repayment period, it's equal to closing payable divided by purchases multiplied by 365, which is lower than the budget and the last year and the industry. The last ratio is equal to average stock holding period, which is equal to 35 days, which is higher than budget, the same as the last year, and higher than the industry average. So let's make a quick revision for the ratios we have on this chapter. We start with the profitability ratios. There are two ratios. They are the gross profit margin and the net profit margin. The gross profit margin equal to gross profit divided by sales multiplied by 100. And the net profit margin is equal to net profit divided by sales multiplied by 100. Then we move to return on capital employed. How to calculate the return on capital employed? It's equal to net profit divided by closing capital plus long-term debt multiplied by 100. Then we move to the working capital ratios. There are two main ratios, the current ratio and the quick ratio. The current ratio is equal to current assets divided by current liabilities, and the quick ratio is equal to current assets less inventory divided by current liabilities. And finally, we move to the liquidity ratios. There are three main ratios in the liquidity ratios. It's equal to, they are average debtor repayment period. It's equal to closing receivable divided by sales multiplied by 365. The average creditor repayment period, which is equal to closing payable divided by purchases multiplied by 365. The average stock holding period, which is equal to average inventory divided by cost of goods sold multiplied by 365. How to calculate the average inventory? It's equal to opening inventory plus closing inventory divided by 2. That's all for today. Thanks for listening.